Good morning, everybody. I'm back again. The time here is 6:24 a.m. I always like to say that because I'm on a 17-hour time difference. I know I said I was going to record once a week, but I recorded an episode yesterday, and I really enjoyed it. I really enjoyed talking. I guess writing's not enough at this point. I write every day, but it's good to have some feedback a little sooner. But today I want to talk about why I became an income investor. Income investing is a lot different than dividend growth and index fund investing. Income investing is basically trying to rebuild a paycheck. Dividend growth is more of creating a nest egg that pays you. And index fund is pure growth, pretty much. And when you finish your passive income index investing at the end, then you you sell your index funds for cash, right? And that's something that I don't want to do, right? I have index funds, but I don't ever want to sell them. So income investing is replacing your income with dividends, high yield dividends. All right, so I took some notes on my article, okay, why I became an income investor. The book is on Kindle Unlimited. Pick it up. Also, everything I do is for free too, as well. So everything I put out is free as well. Gary V, somebody I really respect, he says, do everything you do for 14 years for free, and then you'll have an empire. So I'm on year one. So I got a long way to go. So I like to give away my stuff for free. If you want to read it on Kindle or support, go ahead. But everything I have. So the link's in there for the article as well. All right, so let's jump into it. So what I try to do is I read the article real quick. Again, I take out 5 key points. That way I stick on topic. That way you can follow along if you're reading or after you read and get more clarification. Okay, so let's start with retiring overseas with a military pension. All right, so when in June 2019 we were in Turkey, and I was like, okay, hey, I can retire over here. Me and my wife were talking like, hey, if my pension after 25 years, 30 years is somewhere between 5 to 8,000 with disability, we'll be over here, be able to live comfortably. Cool. However, the kids will still be in the States. All right, so if we have to go back to the States, that's going to be roughly 2 to 3,000 each time we go back. Plus, when we get there, kids are probably going to need money. We have houses back there, yada, 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 right? So as much as it would be great to retire overseas and just live off the pension and retire at age, 45 and be good, there has to be something different. There has to be more, all right? Because we're going to put ourselves into a budget situation or a fixed income situation, right? I just wrote an article about fixed income versus budget. Now your life is based on your income, as opposed to a budget is you have as much income as you need. You live on what you choose to live on. All right, so fixed income versus budget. So if I were to retire overseas without any additional passive income, I will be on a fixed income. And although Turkey is cheap or not inexpensive compared to the States, going back and forth and maintaining stateside residence is going to be expensive. So I started looking into the word passive income. All right. So that's kind of the thing that got me started. And one of the first things that came up was dividend growth investing. So when I first started, I was a dividend growth investor. My first 10 stocks were dividend growth: McDonald's, Papa John's, I think it was ExxonMobil, things like that. And this is 2019, before the pandemic. And they were good. But as I kept reading more and more, I realized that I was more of an income investor. I wanted to replace my paycheck. I wanted an additional stream of income that gave me current income. Current income means today. I want to invest in something that within 3 weeks is going to pay me a nice chunk of change. All right, so that's income investing. All right, so during that process, we kind of looked at the whole overseas passive income landscape. All right, it's more than just income investing, dividend growth. It's also royalties, also crypto. It's also rents, right? Rental income. There's a lot going on. Plus your military pension, plus your TSP, Roth IRA. All these things play into one, and you have to understand all of these things for long-term success, right? So we put that all together, and I start focusing on those individually. And income investing is one of the things that I really enjoy talking about. I really love focusing on, because it's just, to me, it's incredible because it makes sense, right? You're not really at the whims of the market. All right, and I'll get into that later. Okay, so I wrote a whole article about dividend growth versus income investing, so I won't go too deep into that. When I pull that article up, I'll go into the particulars about that. I want to touch base on it real quick though. Dividend growth, again, is basically building a nest egg that pays you. All right, so it's somewhere in between income investing and index fund investing. All right, so index fund is probably going to give you 8% growth, 9% growth a year. Got it. Index funds probably going to do the same thing. Or I'm sorry, dividend growth is probably going to do the same thing, but it's going to be maybe 5% growth and 4% dividends. Income investing is going to be more 9% income dividends. All right, so dividend growth is right in the middle. And so the goal of dividend growth is to let your stocks grow, say Starbucks, McDonald's, Procter & Gamble. You get some new ones like Ally Bank is a new one. Carrier, I bought Carrier right when it first started giving dividends. So Carrier is going to be a long-term hold. Microsoft is going to start paying more dividends over time. Apple pays a small dividend. But those are things you hold. So you're going to have a big nest egg, right? It won't be as much per se as your index fund, but it's paying you, right? So say you end up your career with $1 million in dividend growth. It's going to pay you somewhere between $30,000 and $40,000, depending on the yield, 3 or 4%. But you won't have to sell McDonald's stock in order to survive, right? So that's the purpose of dividend growth. Index funds, they pay 1% dividends or less. So you're going to have to sell your index funds, right? So you'll get to your goal faster, but you're going to have to sell. And when the market's down, you don't want to be in that position, right? So dividend growth is more like a long term. I created dividend growth, but it's more for my children's enjoyment than mine, right? Okay, so income investing is more of today. Like I could build a portfolio of $100,000 at 8% yield, right? And that's going to pay me $8,000 a year, right? So now, the way I found income investing was on Seeking Alpha. Seeking Alpha is probably one of the most popular investing sites out there, right? In the comment sections where you can get a lot of good nuggets, bad nuggets, right? So you got to take everything with a grain of salt, do your own due diligence, but at the same point, it's a good place to get started if you don't know, right? I still read Seeking Alpha at least an hour a day, right? I stumbled upon a cat named Rita Morwa. I think he's from a different country, so his last name Mora. So it's in the article, and he's a hardcore income investor, right? He doesn't buy anything less than 6% dividend yield, which is amazing, right? Especially if you have different portfolios, you can really focus on your income investing on the side, and you can still have growth. You can still have your index funds, but your income investing portfolio can be really hardcore, right? So I've been reading him for about a year. Every day he writes, which is one of the reasons why I write every day. But it really opened my eyes to the benefits of income investing and just being able to take your paycheck that you get from work, convert that to income. That income pays you. I was telling my friend Terry yesterday, we were talking on the phone, that I get my paycheck in Wells Fargo for my income stocks. I get like $80 a month on the first of the month. I was like, it's almost better than my Marine Corps paycheck. It's not, because obviously my Marine Corps paycheck's a lot more. But to create your own paycheck, so you do that with the intent of maybe you do that 5 to 10 years, and now your income investing is paying you $600, $800 on the first of every month. I mean, it's exciting, and you're in charge, and you're in control of it. Okay, so one of the examples I wanted to give was a mortgage REIT. Okay, I have two main mortgage REITs, and they are AG&IC and NLY, right? Annuity Capital. And mortgage REITs, they don't buy properties, they buy paper, they buy loans. Okay, so they get most of the way they make a profit is by the yield curve, meaning they since they're lenders, they can lend, they borrow their money, right, say at 1%, 2%, because the interest rates are low, and then they lend at, say, 7%, 8%, okay, whatever the difference is. They obviously have different things, but say they make a 2% profit. So their share price fluctuates based on the yield curve and how the interest rates play out. So when the yield curve was really narrow, meaning that they borrow at 1% and maybe they can sell or loan at 2%, then their share price is down. But when the yield curve is high, right? So they borrow at 1, loan at 9, then their share price is high. All that's to say, right? We'll get deeper into that over the years. All that's to say is you have to know what you're investing in. You have to know why their share price is down. You have to be able to evaluate, when's a good time to buy them, right? But if you know how to do it, which is really not that hard, you just have to understand how the minutia goes. But if their share price is down 10%, you're like, okay, cool. I read, okay, yeah, the yield curve is down, so, but the yield curve is going to flatten out at some point. In the meantime, you're getting paid 10%, 11%, right? So you'll be able to keep your capital gains if you know what you're doing. But the dividends are important, and that's pretty much everything with income investing. It's all kind of based on interest rates, yield, the housing market, so you have to know overall what's going on. But if you can understand that, if you read about it about 6 months in, you're going to understand it, and it's going to be very easy to invest in these products long term because you know why the prices are going up and down. You're not guessing. Like when you invest in, say, Google and Apple are kind of solidified, but when you're guessing in something like a Cloudflare, right, a new kind of investment, you're kind of guessing. You think that they have an important idea, but it also has to be managed well. It also has to flow well. Everything has to go their way, right? So you're not really guessing. You kind of know exactly where you're going to get. And that's the best thing about income investing, all right? So my last topic is build your paycheck. That's the main thing with income investing. Set your goals and start working towards it. All right, so you get your paycheck from military or wherever you work. You cut out to make sure that your expenses are low. Then you have that difference. The difference, right, is where you want to invest. And then your income portfolio will start paying you back. And then you choose what you want to do. Right? You can reinvest everything. Cool. It's a little boring for me. I like to have it. I like to have my cash stockpile, at least a portion of it, so I can look at it, and then I can make a decision. Like, okay, this is the stock that is where I want to put my money in today, right? So income investing has closed-end funds, business development companies, MREITs. What else we got in there? Preferred shares. With preferred shares is a whole. I did a whole 5-part series on preferred shares. They're really, really amazing. But again, you have to know what you're getting into, right? Baby bonds are just like preferred shares. So all these things, all these tools we have are very valuable. You have to understand. You have to read on these things, which, I love talking about it because it really pays off. You can see a preferred share for, 30% under market value, buy it with your yield at 14%, 15%. And then when the yields go up, then you're back to you have capital gains, right? And I can show you how I did that, back in October of 2020 when all the preferred shares were down. Now everybody wants yield. So preferred shares, are back to even, right? So you can look at the market and look at the good buys very easily. You can scan real quick, see what's a good buy and purchase, right? You're not guessing like, oh, is McDonald's stock high today? I don't know. What are they going to be doing tomorrow? What about that plant-based burger they're bringing out? How's that going to affect the stock price? You don't know. With income investing, you don't have to think about any of that, right? You're like, okay, stocks are down because of this. Okay, buy. Very simple. All right, so I got a little deep because, it's a deep kind of deal. But that's why I became an income investor. It makes sense. It's easy to finagle your way to a nice paycheck, a nice living, right? And when things are down for the most part, you can just look at the overall market, economy, and some decisions that the Federal Reserve is making, and you know why the prices are down. And you can make a buying decision very quickly, right? There's no real guesswork there, okay? And then you're getting paid to, basically disinvest in bonds and things of that nature. And the good thing about closed-end funds is that they have a manager. So you're paying, more of an expense. However, they have a manager that's proactively following the market and getting the best deals. Anyway, that was income investing. Why I became an income investor. I'm going to be talking about that a lot more because right now is the time to get into income investing because the market's down, right? Your capital gains are going to be flat for the whole year probably, if not more, right? And if you didn't know, when prices go down or when interest rates go up, the stock prices go down for growth stocks, mainly because of their growth is tied to future earnings, right? So when you have high inflation, your future earnings are lower, which lowers the current price, right? So just something I'll dig into more deeply in time. So with that, make sure you check out the article. I'm going to link it down below. Subscribe. I think I have like 19 subscribers, but that's fine. You got to start somewhere, right? I posted in my group yesterday about the compound effect, the book. All right, so I have that, my 5 takeaways for that. All right, everything you do compounds. So if you do something bad, it's going to compound. If you do something good, it compounds. So every video you release, every article you release, every dividend you buy, it compounds and comes back to you. Same thing in your love life, same thing in goodwill that you give towards people, adding value. So everything compounds. So it doesn't matter where you start. Just be consistent and you'll gain a following, and try to add value, try to make somebody's day, try to make somebody smarter, help them out, and you'll be fine, right? Trust me, the first month I released books, I think I sold like 1 book, if not. And then last month I sold 55, right? I don't advertise. So it comes along, right? Everything that you do has value if you want it to have value, right? The compounding effect of everything. So with that, I'm going to sign off. I'm going to go edit this video real quick, drink my coffee, and get to work. All right, have a good day. Bye.